on.
I was not going to do any score slides because they've been coming to the previous two.
Well, I'm going to do it just, or I'm going to do one unless you want me to skip it.
No, you can do one. That's fine.
Okay. Can you see what I'm sharing?
No.
No, it's not. Okay. It's so you're not seeing the score screen. Okay.
I am not. Okay, now it says you started sharing. There, I got it. Yeah. So you just need to start. There you go. Perfect.
Okay. Okay. And I've got to move some things around. Are you going to be with me the whole time?
Yes.
Okay, because I've got one other screen that I need to share, and sometimes I screw it up.
We are
So,
a very, very forgiving audience.
okay. If I do, you need to step in and say, "Hey, Richard, they can't see that screen." What I'm gonna do is I'm showing them tabs 6, 7, and 8 of the financial plan.
Oh, okay.
Yeah, the outline or the original simple steps for that score sent to us about this time last year was terrible.
Yeah.
I had to redo the whole thing, but this one seems to be relevant.
Good. That's what we're all about, relevance.
Yeah, I've got good feedback on the rewrites that I did.
Good.
And the interesting thing is, I sent a whole bunch of comments to National, never heard a word. Never heard a word.
Yeah. Well, I was just meeting with Mark on some things, and one of the things we have certainly discovered with this one score concept is they have no idea what happens at the grassroots level. You would be interested in what I did yesterday, or maybe it was the day before. I got an email or copied on an email to a new provisional saying, congratulations, you've been accepted or whatever. And here's your coach, Anita Kayat. And like, she didn't talk to me at all or even notify me that I was. And so I sent her back a note saying, I hope you understand that I was a little taken aback by receiving an assignment without any further knowledge about it. And I would certainly appreciate if you could have let me know, because I might not have accepted it because I had 5 new clients this week.
Yeah. And I had that happen twice.
Yeah. I got back a pretty nasty note from her saying, you were on the list. You put your name on the list to be a coach. So I assumed I could assign you as one. And I sent her back a note saying, the fact that I'm on the list, although I didn't ever see the list, only means that I have the skills and the training to be a coach.
That's right.
And I said, Richard Brooks, who is our membership chair, always contacted us prior to assigning someone to make sure that we were available. And she didn't like that at all.
Yeah, I've had some issues.
If you feel that I have to let you know every time, maybe you want to take your name off the list. I said, fine, take my name off the list.
Yeah, Mark contacted me yesterday, as a matter of fact, to say, hey, do you mind coaching Nancy Tokars? She's done that to me twice. And she is not coordinating with Trisha. So and that's part of the problem. And your situation is exactly right, because to take on 5 new clients and then have to deal with coaching, that's the equivalent of another new client, if not two clients, depending on the
Yeah,
amount you
yeah.
have to spend.
Well, as
Yeah.
a matter of fact, I went ahead. I didn't want I did that aside from the email to the provisional. I didn't want him to think that I was rejecting him. So
Right.
I accepted him and I made an appointment with him. But it was just annoying. And it happened to me previously. Again, when I had RSV and I had bronchitis, I was on pause and she sent me an assignment. And I actually at the time sent it back to her and say, I'm ill. I'm not able to take anybody right now. In fact, my partner was in the hospital at the time.
Ooh,
So she did reassign it. But, if she had just simply asked me if I was available, I would have told her no.
exactly. Or if she would have looked at engaged, she would have seen that you were on pause.
Yeah. So there's no coordination there at all, or
Yeah.
there doesn't seem to be. Although apparently she has communicated my concern to the other people because I got a note from Trisha this morning saying that there was a, a client who was referred to me and was I willing to take it. And I looked up the client and I found out her business was rental and leasing, which I know nothing about real estate. So I said, this is not my area of expertise. You might instead assign her to Steve Schlein.
Well, or Steve or Gary Stevens. Gary
Or
Stevens is
Gary. Yeah.
phenomenal. I mean, that's all he does.
I thought
So,
about
yeah.
Gary, except that he's got a couple clients. I was on Cat last week and he has a couple of clients that he hasn't contacted yet.
Oh,
So
really? Okay. Interesting.
I didn't want to give him another one.
Yeah, yeah. I'm working with him with two clients right now, and he's been really excellent. So,
Well, that's
good,
great.
good. Okay, it is 1:58.
11:58. Do you want to start?
Let's rock and roll.
Okay, here we go. We are open. So good afternoon to those of you who are just joining us. We're going to wait a couple minutes to allow other people to log on, and then we will get started. While we're waiting, I'll just let you know that you will be receiving a copy of the slides and a link to the recording, probably within the next day or so. So you really need to take notes. You can just relax and enjoy the presentation. Okay, do you want to go ahead and get started, Richard?
Yes.
Okay, so welcome everybody. We're delighted that you decided to spend an hour with us today, maybe on your lunch hour. So feel free to grab your sandwich and enjoy it while you're watching. We are very fortunate today to have Richard Brooks with us, who is a score mentor with Cleveland, as am I. And he's also an expert on finance and has spent a great deal working on these slides and hopefully providing it in a way that will be meaningful to you. So I'm going to turn this over to Richard and ask him to get started.
Thank you, Anita, and welcome everybody. I hope you've all had a good week, and hope you're looking forward to the content of this workshop. Financial management is probably not the most exciting area that you can work in, but it's one of the most critical. I can tell you from my past experience, and I've either started or acquired over 20 businesses in my career, that not knowing the financial condition of my business could lead to disaster very, very easily for any one of those businesses. And it is really essential that you understand uh, your business finances on a day-to-day, a week-to-week, and definitely a month-to-month basis, no less than a month-to-month basis. So we're going to go through some of the financial basics today for you. Now, let me just apologize to you right off the bat. I have a cold, and so if I start coughing, I'm likely to just mute myself for a second so that you don't hear all the coughing and wheezing that's going on. But with that said, want to go ahead and just briefly introduce SCORE. Some of you may not be familiar with SCORE. The majority of you, I think, have attended previous sessions, but SCORE is a national organization. SCORE Cleveland is the local chapter serving the counties that you see in Northeast Ohio. On our screen, this is our website. We provide mentoring services and business advisory services and education, not only to the Cleveland chapter, but some of you are from chapters outside of our service area, and we're delighted to have you today. And if you have any questions about the content of the material that I'm going to present to you today, your local SCORE chapter can provide you with a mentor to help you. Okay, let's talk about financial planning, and that's what this session is going to focus on. It fits into the scheme of the 5 sessions that we've been talking about for the 5 simple steps to start your business. We've already gone through the startup basics, the business concepts, how to develop a marketing plan as part of your overall business plan, and now the financial plan. And if you think about the overall business plan, you talk about what your business is all about and how you're going to market it, how you're going to organize it, who the key players are going to be. But now you've got to have some numbers that back up what you think you're going to be able to provide. And these numbers are important not only if you're looking to get a loan or investors, but they're also benchmarks for you, even if you don't need financing, from an outside source. They're important to you so that you have benchmarks to check your financial success as your business develops. And so that's what we're going to be talking about today. Okay, well, what's the importance of financial planning? Or that's the first thing we're going to be talking about. Why is financial planning important? We're going to be talking about what's the difference between financial and managerial accounting, because they are different. The 3 most important financial statements that you will need to work with. And then we're going to start digging down into some more detail. We're going to talk about what are fixed operating expenses, how to forecast sales, sales units and sales pricing, and then understanding financial information. And we're going to talk in depth about an income statement, a cash flow statement, a balance sheet, and if we have time, a little bit of diagnostic metrics. So that's what we're going to be talking about today. Okay, financial planning and goal setting. The reason why you do this is to match your personal income goals with a financial plan to achieve them. If your personal financial or your personal goal is to be financially independent, and your financial plan says you can't do it, well, then there's something wrong there. You're out of sync. And so what you need to do is first identify what your personal income goals are. I need enough money to support myself and my family. I need enough money to buy a new house, whatever it happens to be. And then develop a financial plan that is going to help you achieve your goal. Something else that it does, gain a better understanding of the financial risks and rewards. I have clients right now that are really working through this, where the company is not making enough money to support them. And so we're working through various strategies, financial strategies, and financial tactics that will help them actually turn that around and be financially successful. It allows you to identify early development and startup costs, ongoing operations, expenses, and funds you need to finance the business. One of the key issues that new businesses and even existing businesses have is underfunding. They don't anticipate all the costs that are going to be necessary to actually start a business. One of the things that I tell my clients fairly often is that starting a business normally takes much longer than you anticipate and costs a lot more than you anticipate. And one of the issues there is they underfund their initial operating expenses. They plan on maybe $5,000 or $10,000 to get the business open, but either they don't have enough sales in the first couple months to replenish that amount and pay all their bills, or the amount that they were originally looking at, the $5,000 or $10,000, was not sufficient to actually get the door open. And the last thing you want to do with a lender or an investor is to say, I'm 90% of the way there or 95% of the way there, and I don't have enough money to actually get the door open and sustain my business for the next 3 months. So you want to make sure that you understand all the early development costs and all the costs that are going to be necessary to actually get your business going and sustain it until you have a sufficient client base, sufficient sales to actually support the business. And then finally, have a plan to help guide the business decisions and monitor the results. What we're saying here is develop a forecast and use that forecast as a benchmark for your financial success. So in the first 3 months, if you think that you can make $5,000 profit, that would go into the plan. And then when you actually start the business, 1 month, 2 months, 3 months come along, and you're measuring whether you're going to be able to make that $5,000 or not in the first 3 months. And that's a cumulative $5,000. So if you lose $5,000 in the first month, but you make $10,000 in the second month, well, you're already at the $5,000 level, so that's fine. So it's those kinds of benchmarks that you can use to verify whether you're on track in your financial plan. Okay, What's the difference between financial accounting and managerial accounting? Simply stated, financial accounting is a process of recording and summarizing your business from a historical point of view. You're looking back at your recent business, last month, last year, last quarter, whatever it happens to be. Managerial accounting actually is the opposite. It's looking forward. It's taking the information when you have it from financial accounting. What did I do last month? What did I do last quarter? And then using that to forecast what you can do in the future. And that's the difference between the two. We're going to focus today primarily on managerial accounting practices. Okay. But that does not discount the importance of financial accounting. The old expression, you don't know where you're going unless you know where you've been. Well, that applies here as well. So the financial accounting will tell you where you've been, and the managerial accounting will give you a path to go forward. Okay, financial planning process. Clearly write out your business and your personal goals. One of the first questions I ask all new clients that I have is, what are your personal goals and what are your business goals? And a lot of times clients haven't really thought of that. And so my comeback on it is that you really can't write a successful business plan, including a financial plan, unless you know what you want to achieve. And so writing those goals out and making sure that you understand them and anybody else involved in the business understands them is critical. And then you draft a business plan that achieves those goals. We've already, been working on that for the past couple simple steps sessions. And then you create a financial model that supports the plan. Now, SCORE has a really terrific financial model workbook that is available to all of you. It's available online at score.org. And it's really good. And your SCORE mentor can actually help walk you through it. There are a lot of things, especially if you're not familiar with financial planning, that may be a little strange to you. You may not be familiar with, and your SCORE mentor can actually walk you through that. We do have a self-study guide, but I have found that direct mentoring really works as well, if not better. It's an extensive Excel workbook. If you're not familiar with Excel, really good idea to go ahead and do a YouTube class on basic Excel. You don't need any form of advanced training in Excel because all the formulas that you need are already embedded in this workbook. So something to keep in mind. And then what you're going to do is you're going to test the plan in the financial model. Does this look really attainable? One of the things that I ask my clients to do is actually create 3 financial plans. One is worst case scenario. What happens when things go wrong, or I don't get all the sales that I wanted, or my costs are out of control, or whatever? So we develop a worst case scenario, and then we develop a best case scenario. I open the door and customers are walking in. My website is really active. I'm getting a lot of traction on social media. Everything that's happening, and that's the best case scenario. And then I ask them to identify something in between. And that's the scenario that we really try to work on. Okay. And so that's really important. And it's a test of the financial plan. Can I survive with the worst case scenario? What do I do under the best case scenario? And the model in between, is this really realistic? Can I sell this to investors? Can I sell this to lenders? Does this really make sense financially to anybody involved in the business? Then revise the goals and plan as necessary. When I do financial modeling with my clients, it is not at all uncommon that we do this 3, 4, or 5 times before we actually have a comfort level with the goals that we're setting and the plan to achieve those goals. Then revise the financial model as necessary, and finally finalize the goals, the plan, and the financial model, and be prepared to present them to investors, lenders, or just for your own use. And keep in mind that your business and your financial plan are living documents. So you should go back and review them periodically, at least every quarter on the financial plan. And then at the end of every year, create a rolling plan so that years 2 and 3, and I'm going to show you a 3-year financial model. Year 2 becomes year 1 for the next year, such as from 2023 to 2024. And then year 3 in your financial model becomes year 2 in the example I'm using, year 2025, and then you'll add on a 3rd year on that. So you have a 3-year rolling forecast. And the way you do that is you just use the financial model. But then what you do is you use your financial accounting to say, what did we do? And then you update the current year, 2024, with the results of what you expect to happen in 2024 versus 2023. Most businesses take 12 to 18 months to the term is stabilize. And what that means is, work out all the operating kinks and develop the client base, the customer base, and you go from there. So you would look at, as an example, 2023 to see what business you've already done, and then see what the trend is. Are you growing? Is March of 2023 worse than what you anticipate March of 2024 to be? And you can see where you're going with that using the reporting that you have from 2023, and then you build on 2024 with that. For goals, I like to use SMART goals. And SMART is an acronym for specific, measurable, achievable, relevant, and time-bound. And look at the example that we provided you here. By the end of the year, by the end of 2024 in this case, my business will have at least $50,000 in revenue, $10,000 in net profit, and have a customer satisfaction rating of 9 out of 10. You notice that specific, it gives you specific numbers, $50,000, $10,000, 9 out of 10, measurable. Can I measure $50,000 in revenue? Yes. Can I measure $10,000 in profit? Yes. My customer satisfaction rate is measurable. Is it achievable? Okay. And achievable is often one of the more difficult things to understand, because what it really says is my company capable of doing this? Do I have the staff? Do I have the product? Do I have the facility? I have a client right now who has realized that their goal for 2024 may not be achievable because their facility is too small. They're manufacturing something, and the volume that they see coming in, the request for orders, they may by mid-year have to look at moving to a different facility, a larger facility, because the current facility isn't available. In addition to that, they've got to figure out how they're going to add on 2 or 3 more people to staff the larger facility to meet their financial goals by the end of the year. So that's what achievable means. Relevant. Is it really relevant to your business? Okay. That's really important. That whatever your goals are, they must be relevant to achieving to the success of your business. And finally, time bound. You notice here, the first thing it says in my example is by the end of year 1, it is time bound. I know exactly when I expect to achieve these goals. So that's really important. And by the way, there are, if you want more information on SMART goals, there are all kinds of online references. You can go to Google, just type in SMART goals, and there are more than a dozen references that you can use on that. Okay, let's talk about the three financial statements that we're going to focus on today, because these are really your units of measure, how you are going to measure the success of your business. The first one is income statement. The income statement shows you the company's income and expenditures. It also shows whether a company is making a profit or a loss for a given period. Okay, some businesses are seasonal, and so you may make a loss for 1 or 2 or 3 months out of the year, and be making a profit for the rest of the year, and that's fine. As long as you know how to manage during the loss periods, you're good. And so the income statement shows you whether you're making a profit or a loss. Keep in mind that the profit or loss is a financial term, meaning are you making money or are you losing money? And that impacts such things as taxes, and it can impact the credit rating of your company. So that's important to monitor and understand whether you're making a profit or a loss, especially for the credit rating of your business. The cash flow statement discusses how much money you're actually bringing into the business and how much money is actually going out of the business. So it talks about cash inflows and cash outflows. And there are several differences between this and the income statement. You can actually have a positive cash flow. In other words, you're taking in more money than you're spending, but actually have, for tax purposes and for credit rating purposes, a loss. And you can do that for a short period of time, not a long period of time, but a short period of time. And the reason why is you're looking at these two, the information these two statements are giving you from different angles. Okay, and I'm going to show you some of that in just a few moments. The third really important financial statement is the balance sheet. And the balance sheet shows you the value of your company assets, any outstanding short-term and long-term liabilities that you have. And the difference between the two is the owner's equity. And that's really what the business is actually worth. Okay, so there's a financial formula that says assets plus assets equals liabilities plus owner's equity. And so the balance sheet shows you what all your assets are, and then what all your liabilities are, and then whatever the difference is between the two, that is what your equity, what your investment in the business is actually worth. Okay, let's talk a little bit more about the income statement. The income statement shows you the company's income and expenditures, and this is really critical. What I'm going to do now is I'm going to drop out of this presentation, and I'm going to go to a different presentation. If I can find it, there we go. And I want to share this. Give me just a minute, please. Okay, Anita, can you see that?
Yes, yes.
Okay. Okay. What I'm showing you is that actual financial workbook that I mentioned to you that SCORE can provide to you. And you can see it's an Excel model. Okay. what I'm showing you here is the income statement. And so let's walk through this a little bit. You notice that this is a 1-year income statement. You can see that because it covers 12 months, and you can see that here toward the top. Okay, so the first thing it does is it talks about all your sources of income. And so you have cash sales, you have accounts receivables, you may have commissions, there may be other sources of income. One of the questions that we get sometimes on this presentation is, well, what about credit card sales? Credit card sales are actually cash sales. And the reason why credit card sales are actually cash sales is normally the money can be put into your business bank account, checking account, within 24 hours. And so it's even though somebody may be paying by cash, or pardon me, by credit card, it normally takes 24 hours or less to actually move that money from the credit card processor into your business bank account. So that's why we call that cash sales. And then we go into detail on all. I was actually looking at the cash flow statement. Please accept my apology on this. The income statement actually breaks down all your sales by product. And you notice we allow 12 different products in this model. If you've got more than that, the model can be modified with the help of your SCORE volunteer or your SCORE mentor, but also you can combine certain products from a sales point of view to do your forecasting. So here's your revenue, and then here is your cost of goods sold. Cost of goods sold is the direct cost for selling. So it's the cost of the product. So if you have, let's say, a hair salon, and you're cutting hair, and you're doing shampoos, and you're doing hair coloring, that would be considered not including the labor, any of the materials that you need, such as the hair coloring product. It could be hairspray. It could be other forms of product requirements. That would go in here. Another example that we use in another workshop that we do is a puzzle manufacturer. The cost of making the puzzle, the raw material for the cardboard that the puzzle is on, and the ink that it prints on the cardboard, and the storage, the warehousing, all goes into the cost of goods sold. And so you would have the cost of goods sold there, and then that will give you what is called the gross margin. And the gross margin is the revenue less the cost of goods sold. And that's what your gross margin is. And that's a really important statistic to know, because most of my, I'll give you an example. Most of my clients are restaurants. My background is hospitality. And when I see a client that has a gross margin of 45 or 50%, I say to them, you can't make money in the restaurant business with a gross margin of 45 to 50%. You have to have a gross margin of somewhere between 25 and 33% in order to make money. And there are a lot of reasons for that, because there's a lot of overhead in the restaurant industry, one of which is payroll. So first you have your costs of the food, and then you have to, what am I paying my employees? And I know a lot of you have seen that restaurants today, a lot of restaurants are looking for employees, and they have to make sure that they are offering a competitive wage, and that's a combination of what the restaurant pays them plus their tips. And if that total is not competitive, they're not going to get anybody to work there. So what's happened is the wage that the restaurants have to pay before any tips has increased significantly. When before COVID, a restaurant could pay $7.50, $8 an hour, and then the balance would be made up with tips. Today, restaurants have to pay $12, $13 an hour plus tips in order to be competitive in the labor marketplace. Well, that creates an issue if a restaurant has 45% food cost and then another 30% labor cost. They're already well above being able to provide a return on investment to their owner. So that's really critical. Okay, let's move ahead. Payroll would be the next deduction. And then look at all the operating expenses that we have here. Okay, we have a bunch of operating expenses, and these are things that you need to take into consideration, like advertising, vehicle expenses, commissions and fees. Commissions and fees are if you have a third party that you're paying a commission to. So, for example, if you're using Amazon or you're using Shopify or you're using Etsy, you're paying a fee for each sale that you make on those websites. The cost of that sale would be on this line. Okay. And then contract labor are 1099s. So those are people that are not direct employees of yours, that you have contracted for a certain period to do a certain task. Be very careful with contract labor. Don't try to call all your employees contractors. The state of Ohio has very specific definitions of what is a contractor and what is an employee. And if you try to classify the people that work for you as contractors, and that does not go along with the state's definition of what a contractor is, you will be fined, and you'll have to make up payroll taxes and workman's comp taxes, and that can be very, very, very expensive. So work with your accountant to make sure that you have classified the people that work for you correctly, and that they're not contractors or they're not necessarily direct employees of yours. Don't forget about your insurance, and this is general liability and theft and fire and property damage, all the things that you may be involved with. Legal and professional expenses, that would be your accountant and your lawyer. Any business licenses that you need, rent or lease. You notice we have two lines here. The vehicles, machinery, and equipment, that's one line. And then if you are renting space in a building, that rent would go in the second line here. And then any repairs and maintenance you have to pay for. Operating supplies. Operating supplies are not inventory. Operating supplies are things like cleaning supplies, office paper, letterheads, business cards, those kinds of things. And then bank and credit card fees. One of the things I recommend to my clients is that when they're doing their sales forecasting, on this line here, whatever their sales are, they take 3% of those sales per month, and that's what should go in this line right here. Okay. And the reason for that is the majority of sales today are by credit card. And so you might as well anticipate the credit card fees and the bank fees up front. And so that would go in here. And then if if you're doing any business travel or entertainment, you can forecast that there. Any utilities that you have to pay, electric, gas, water, whatever it happens to be. And then notice that the worksheet then totals all your expenses for you, just like it totaled all your cost of goods sold and your revenue. And then tells you what your income is before other taxes or other expenses. And then you notice there are a whole bunch of other costs that go against your income. Okay. Amortization of startup expenses. What the government allows you to do is usually over a period of 3 years, it allows you to take your startup costs before you actually open the door of your business, buying your initial inventory, your rent in the space that you're renting before you actually open the door, any transportation costs beforehand. Keep track of all those expenses. Pre-opening advertising would be another example. And it allows you to write that off as a legitimate business expense, usually over the first 3 years of your business operation. Work with your accountant on that. And your accountant can tell you what can be amortized and over what period. And then depreciation, if you have any physical assets in the business, you're allowed to depreciate the cost, write off part of the cost of that over a specific period as well. And it depends on the product. For example, computer systems, you depreciate normally over 3 years because computer systems don't have the same life as, let's say, a vehicle that you buy, not lease, but that you buy. And if you buy a vehicle, that may be good for 5 or 7 years because the life of that product is longer. Computer systems tend to be obsolete a lot faster. So that's an example of what it is. But you're allowed to write off your investment in that as a legitimate business deduction. And then any interest expenses that you have for any loans that you have outstanding, payment of the principal of the commercial loan or the mortgage, any credit card debt that you have, any vehicle loans. And then what happens is it takes all these different expenses and deducts it from the income before other expenses, and that gives you your net income. Okay, and that's the line you're really interested in. So the reason why this is called an income statement is after showing all the revenue and then all the relevant expenses, it shows you whether you made a profit or a loss. Okay, and now what we're going to do is we're going to go back and I'm going to start sharing again, but we're going to look at the cash flow statement. So give me just a second. Anita, can you see this?
No, no.
Okay, that's why I needed to verify here. Okay. Okay, can you see it now?
Yes.
Okay, very good. The cash flow statement summarizes the flow of cash, what is coming in and what is going out. And it includes similar expenses to what you saw in the income statement, but it summarizes some of that. It's not as detailed as the income statement is. So now what I'm going to do is we're going to go ahead on and I'm going to share with you um, the uh, the income statement, which is what, pardon me, the cash flow statement, which is what I kind of started with earlier and just had the wrong tab up. So on the cash flow statement, what it does is it starts with, you notice, an opening balance. And one way or another, you need to determine how much money you think your company is going to need as a minimum on a monthly basis. And so that forecast would go in on this beginning balance line, and then you have all your different sales, cash sales and accounts receivable, and then you notice down here in cash outflows, investing activities normally, most people don't have that, don't even worry about that. That means, are you investing money that you have in either other businesses or other securities? And then on line 16 here, new fixed asset purchases, maybe sometime during the year, you decide that you need a new sewing machine, or you're going to buy a new vehicle, whatever it happens to be. It would show the cash outflow there for whatever you're buying. And then additional inventory. This is not inventory for cost of goods sold. Okay. This is inventory that you're thinking that you're going to sell in the future. So a good example of that would be, for example, I'll use the puzzle manufacturer example. They would be buying additional inventory in June, July, and August so that they could sell that inventory at Christmas time. And so what happens then is there's a drain on their cash in June, July, and August. They don't have the sales to support it, but they'll make up for it in October, November, and December because of Christmas. So you need to forecast that in your model, and that's exactly what is intended here on this line. And then you have your regular cost of goods sold, which is your current numbers, and then your operating expenses, and we saw what those were in the income statement a few moments ago. Your payroll, any taxes that you owe. Keep in mind that sales taxes are a pass-through. Sales taxes are not money out of your pocket. They are sales taxes are money that your customers pay that you pass along to the state. So this line here, taxes, is your income taxes. It is not your sales taxes. And then any under financing activities, here are your loan payments. Excuse me. You notice in the income statement, your loan payments are detailed. Here's your mortgage. Here's your commercial loan. All those different kinds of loans. Here it's just summarized as one line. And then owner's distribution. Owner's distribution is something you need to be aware of. This is not what you are paying yourself. This is, consider it like a bonus to yourself if you have sufficient money to actually give yourself a bonus. If you don't have enough money to give yourself a bonus, then it makes no sense giving yourself a bonus. And the reason why we have it here and not on the income statement is because this will tell you, the cash flow statement will tell you whether you have enough money coming in to give yourself a bonus. Okay. And then if you have a line of credit with a lender, this will show you whether you have to draw on that line of credit in order to make your to maintain a positive cash flow. And then if you've borrowed on that line of credit and now you need to start paying it back, this will show this line here shows any payments, and you will determine what those payments are to reduce and eliminate your line of credit. And then dividends paid. If you have investors and you need to pay them dividends, we're not talking about buying out their stock. That's a different kind of a thing. But let's say that they are expecting a 5 or 7 or a 10% return on their investment, and it's due every quarter or every half or every year. You would financially account for that on this line here. If you don't have investors, outside investors other than yourself, then this line is irrelevant. You don't put anything there. And then you notice what happens. The worksheet, the report actually shows you what your total cash inflows are, what your total cash outflows are, and what the differences are. So the idea here is to have positive numbers on net cash flows. In other words, did you take in more money than you spent? And that's what's really important there. And then how much money is left in the bank? That's this line here. And then if you needed a line of credit drawdown to make that happen, this will show you how much money you had to borrow from your line of credit in order to make this work. And then what your ending cash balance is. Okay. And then this ending cash balance, for example, if we had $10,000 here, that automatically comes up to the top here, you see, for the next month. Okay. And so what happens is the ending cash balance for month 1 becomes the opening cash balance for month 2. The ending cash balance for month 2 becomes the opening cash balance for month 3, and so on. So the importance of this report is to show whether you're taking in more money than you're spending, or whether you're spending more money than you're taking in. Keep in mind, as I mentioned before, some businesses are seasonal. So you want to keep as much cash in reserve as you can during the good months so that you have it to spend during the lean months. And this report helps you with that. And you notice the other thing about this report is it doesn't talk really about taxes other than just, if you have to pay taxes. It shows it as a cash outflow, but it does not impact you the way it does on a income statement, because on the income statement, you can have a situation where you actually make money before taxes. This one is different. Okay. And finally, I'm not going to show you the slide because I don't want to keep on going back and forth. Let's talk about the balance sheet. The balance sheet, and Anita, you can see the balance sheet, am I right?
Yes.
Okay. The balance sheet is a snapshot in time. It's normally done at least at the end of every fiscal year, and it may be done at the end of a quarter or at the end of a month, but it's a snapshot in time of the health of the business at the time the snapshot is taken. So, for example, here we have current assets, and included in current assets are cash any accounts receivable that you have, any inventory that you have that has not been sold yet, and any prepaid expenses, and then other initial costs. And so what we're saying here, those are your current assets. Current assets are assets that you could sell today and get cash for. Okay, so for example, cash is obviously cash, but accounts receivable, there are ways of selling your accounts receivable at a discount. There are companies that will actually buy your accounts receivables from you. And a really good example of that is clothing manufacturers. Okay, it is not at all uncommon for them to sell their receivables from stores like Macy's and Kohl's and whatever else is out there. Those stores might be on 60 or 90-day payment. And so the clothing manufacturers need the money now. So what they will do is they will sell it to a third party at, let's say, 70 cents on the dollar. And then the third party is responsible for collecting, the full amount. And so your accounts receivables can be converted to cash. Your inventory can be converted to cash, and prepaid expenses. You can get refunds off of those if for some reason you needed to do that. And so that is considered current assets. And then you have your fixed assets, your real estate, any leasehold improvements. Keep in mind that these two, the real estate and the building, the land and the buildings, you must own those. That is not renting, that is owning. However, if you're renting and you do improvements on the building, that is an asset. Your improvements on the building is an asset. And so you can show them here. Any equipment that you own, not equipment that you lease, but equipment that you own, any furniture and fixtures that you own, any vehicles that you own, those are all part of your assets. So the total assets is your current assets plus your fixed assets. And notice here, less accumulated depreciation. And what that means is, let's take a vehicle, for example. A vehicle may be, the value of it may depreciate over 5 years. And so what happens is, if you buy a vehicle for $30,000 and you depreciate it over 5 years, okay, that means that you're reducing the value of the vehicle by $6,000 a year. Okay, that's called straight line depreciation. Each year, you take the value, the $30,000 in year one. In year two, it's $24,000. In year three, it's $18,000, and so on until it gets down to zero. So this line accounts for the accumulated depreciation. So here's your total assets, and then here are your liabilities. Any money that you owe, and any money that you, on accounts payable. This would be for things like inventory and supplies and other things that are current, that you owe in 30 days or 60 days. And then here are your other loans. These are other debts that you have to pay, okay? And then when you take the total fixed asset or total assets right here and subtract out the total liabilities, that's what your equity is worth. That's what your stock in your company is actually worth. So let me give you an example here. Let's say that your total assets are $50,000 and your total debts, your total liabilities are $30,000. What that really means then is your total equity is $20,000. And it can be broken down into the value of your stock and then the value of your retained earnings. And your retained earnings is the money left over once you pay all your bills. Okay. So we've gone through the three most important, and it looks like we've got a whole bunch of questions, Anita. So I'm going to stop sharing this, and I'm going to go back and can you see this? It says uh, financial. Anita, can you see that?
Yes, yes.
Okay, very good. Financial modeling. Okay, let's talk about financial modeling for a second. A financial model is simply a forecast of what you think it's going to be able to do. And it represents your best estimate of what you think the business is going to be able to do. It helps you examine the feasibility of your numbers. Does this make sense? Am I going to make money? Am I really going too far with this? Could I do better? So it really gives you a physical representation of where you think your business is going to be financially. And it's a basis for tracking progress. As I said to you, you do a financial model month by month, and at the end of every month, you can use your financial model as a benchmark and for your success. And what I showed you in the three financial examples, the statements that I showed you, is really the results of your financial modeling. And it allows you to make what if changes, and allows you to make changes to your financial plan as your financial condition changes. So for example, let's say that you started your business, or you added a new product line, and when you added the new product line or the new service that you added to your business, you wanted to intentionally start small, make sure that you had all the everything going as that you could control. And so you under forecasted what you thought you were going to be able to do, and you did that to be conservative about your plan. And you find out that, wait a minute, this thing took off like crazy. Well, if it took off like crazy, then that was in the first quarter. Maybe in the second quarter, you take your financial model and you increase what you project for that new service or that new product based on what you see happening in the first quarter, where you already have some sales history. So that would be an example of how you use the model, and then update it periodically to reflect what is actually going on in the business and where you think you're going to be able to go. Okay, steps to building a financial model. First of all, identify your fixed assets, your operating capital, and sources of funding. That's really important. And in this financial workbook that you can get from SCORE, what you're going to see is the very first tab in this financial workbook is exactly this. What do you need for your assets? What do you need for your operating capital? Things like, your advertising and your opening inventory and your prepaid insurance and, your vehicle leases and all that kind of stuff. That would be in there. And then how are you going to finance all this? And that's your sources of funding. The second part is forecasting sales. Frankly, folks, this is the most difficult part of the whole planning process, is forecasting sales. How much of each product or each service that you want to sell are you going to be able to sell on a monthly basis? And there are two worksheets in the financial model that help you determine this. And what you're going to be able to do is go ahead and do a lot of what ifs. In other words, make changes to the numbers to see what the financial results will be when you increase sales, decrease sales, improve your cost of goods sold by maybe finding a different source for a product, whatever it happens to be. So you'll do a sales projection, then you'll do a staffing projection. Now that I know my sales, what do I need to do from a labor point of view to make this work for me? And that's what your staffing projections are going to be. How much do I have to pay them? How many full-time employees do I have? How many part-time employees do I have? And one of the neat things that you'll see in the workbook, if you decide to use it, is it not only helps you identify this, what your staffing requirements are, but it'll also show you all the taxes that you have to pay to maintain your W-2 employees, okay? And then forecast if you will allow customers to have credit with your company and how often you will pay your bills. That's really important because that impacts your cash flow. I have a recommendation for everybody here. Pay your bills within 30 days and do not extend credit to anybody, okay? Tell them they can use a credit card, they can pay cash, but all bills are due upon receipt of an invoice. Do not allow your customers, especially when you're starting out, to extend their payments for 30, 60, or 90 days. And the reason why is they're using you as a credit card. And you are paying interest on your loans, but they're not reimbursing you for that interest. So wherever possible, get paid by credit card, pay the 2.5%, 3%, whatever it happens to be, and get the money in the bank versus allowing somebody to sit on a payment to you for 30, 60, or 90 days because you're paying money on that, okay? And then finally, identify other operating costs. That would be things like your advertising and your insurance and any business licenses, all those things that we saw in the income statement. Okay, and then finally, knowing what your fixed assets are and your operating capital. Fixed assets includes if you buy a building, not if you lease a building, but if you buy a building, the land underneath a building, if you buy it, the furniture that you buy, the equipment that you buy, your vehicles, anything that lasts more than a year. Okay? If something is consumable, if it lasts less than a year, then it's an operating expense. It is not a fixed asset. Okay? And then your operating capital is for operating expenses. It's for, in this case, we're talking about pre-opening, things like pre-opening payroll, pre-opening inventory, pre-opening advertising, but it's also your ongoing operating expenses. And then sources of funding, that includes your equity, okay, what you contribute to the business, any business loans that you get, any lines of credit, and money from investors. Now, a word on the sources of funding, okay? Track all the money that you put into the business before it opens. And that is usually considered part of your equity. Now, what banks often require is that you have 10,000 or 15,000 or 20,000 or 10% of the loan or 15% of the loan or the 20% of the loan in cash available to finance the business. I'm thinking about traditional lenders here, okay? But keep in mind that you can say to the bank, well, I've already spent $5,000 to do this, that, and the other thing, and that is part of my equity infusion into the business. And if you show them how you spent it and where everything went to, they will consider that. So if you're spending a lot of money up front to get the business open and then need the loan, to sustain the business, you can show the equity investment. Work with your accountant on this, because not everything can be included in that. Your accountant can give you good direction on it. And then forecasting sales, identify each item or service that you want to sell, determine the cost of producing that product, not including the labor, just the straight cost. In the case of a restaurant, it would be the raw material of the food. One of the things that restaurants forget to do often is food waste. You buy a case of lettuce and you only use 9 out of the 10 heads of lettuce in the case. That one head of lettuce that wasn't used becomes waste, and quite often restaurants don't account for that waste in their planning. You need to do that. You may have another product, a puzzle manufacturer, 10% of the cardboard that you use to create the puzzles may be waste. And so you need to make sure that you include that in there. Determine the sales price for each product, and then forecast what the quantity for each product will be as far as sales. Okay, and then forecasting your labor. How much labor do you need to actually fulfill the work that you want to get done? So identify what you're going to pay yourself. It is not at all uncommon in year one that owners do not pay themselves anything. But if you need the income, make sure that you plan on what that is going to be. You put that in your financial model. How many full-time employees by classification? If you have, I'm going to use a restaurant again. Let's say that you have to pay a chef $22 an hour, and you pay your full-time cooks $18 an hour, and you pay your general manager $20 an hour, and you all these different full-time classifications. You need to outline what each one is going to be, how many hours a week they're going to work, and so forth. And the worksheet that is in this financial model actually helps you with that. And then identify how many part-time employees you're going to have, how many hours they're going to work, and what their jobs are going to be, and what their hourly rate is going to be. And then if you have any contractors, again, be careful with contractors and make sure that when you list somebody as a contractor, legally they are a contractor, and your accountant can help you with that. Okay, and then here's a definition of a contractor that I pulled out of the state website. The most important thing are right here, where it says people who are self-employed are considered independent or contract workers. So if they're self-employed, that's fine. If they're working for a third-party company, let's say that you bring in a consultant, okay, and the consultant, let's use Accenture as an example. Accenture is a consulting firm. You bring in somebody to help you. They would be considered a third-party contractor. However, okay, whether someone is an independent contractor or company employee depends on the facts in each case. The general rule is that an individual is an independent contractor if the payer, you, has the right to control or direct only the result of the work and not how it will be done. Okay, so that's really important. You say that the work that you do must achieve this end. I must get a report from you, or I must see improvements in my regular employee productivity, or whatever it happens to be. Then they're considered an independent contractor. If you are paying them on a regular basis and you are controlling what is done and how it's done, then they are a W-2 employee. Again, work with your accountant on this. And then forecasting your other expenses. We've talked about this. Advertising, vehicles, and even if you own the vehicle, you still have operating and maintenance expenses, gas, tires, oil changes, all that kind of stuff. Credit card payments, processing fees, loan repayments, monthly rent, if you're renting space, utilities, operating licenses, so forth and so on. All these, you need to at least get an estimate of what they're going to cost you. And if you've got some history, then just use that history and you will be in good shape. Okay. Anita, I want to stop here real quickly and see if we can take some questions. Can you help me with that?
Here are both questions. One, will there be two financial statements, one for financial and one for managerial accounting?
That's a good question. The financial statements that you get, the income statement, the balance sheet, the cash flow statement, those are all going to look backwards, but you are going to create in your financial model duplicates of that looking forward. So let's say that you're in business for a year, and at the end of the year, you have 12 months of financial statements that you can use to look backwards. What you would do is you would take those 12 months of financial statements and apply them to a forward-looking projection of what you plan on doing in the coming year. Okay. Now, if you don't have a business, then the financial model that you create will be your best guess at what you think you can do during your first 3 years of operations. Okay. Next question.
Does it seem chancy if I do not add cash on hand?
Yes, you need some form of cash on hand. And the reason why is there are always going to be expenses that you're going to have to pay quickly. Whether you pay them by credit card or pay them by check or pay them by cash, one way or another, you're going to need some cash. Some businesses call it petty cash. You may have heard of that term, but there are always going to be expenses that you will need to pay immediately or within a very short period of time that you will need to have in the bank so that it's available to you. Okay. It is not at all uncommon, for example, for new businesses to pay for certain expenses upon delivery of a product or a service. So to give you an example, let's say that your truck breaks down and you need to get it repaired and it's a $500 repair bill. Well, you're going to have to pay the company that repaired your truck right away. If you don't have $500 in the bank at that point, you've got a real problem because you may end up having to use your line of credit, which means that you're paying interest on it, or you're using your credit card, which means you're paying interest on it. So as many things as you can pay for and not pay interest on is what you want to do. So you really want a cash balance.
Okay, next question. I have contract drivers. I don't train them to drive. I give them a route. Are they considered a contractor if I offer customer training?
If you offer customer training, but they are still doing their own driving. Again, I really think you ought to talk to your accountant about this. My gut feeling on this is that they could be considered an employee. And the reason why is if you're giving them training on how to treat a customer, that goes back to this definition here, and I'm going to try to go back to it here real quickly. Of how it will be done. Okay, the general rule is that an individual is an independent contractor if the payer has the right to control or direct only the result of the work and not what will be done and how it will be done. Well, if you're providing them with training on how to treat customers, that is a how it will be done. So I would talk to my accountant about that and make sure that by adding that additional level of training, I am not in violation of the way the state defines an independent contractor. Next.
Where can we get a copy of the workbook?
The workbook is available at score.org. Okay, all you have to do is type in financial planning workbook. If you have a SCORE volunteer, if you're working with a SCORE mentor, you can ask the SCORE mentor to forward the workbook and the guide to you. So you can download it from score.org or you can get it from your SCORE mentor.
Okay. I have one client, LaQuinta Johnson, and I'm going to ask her to unmute. You can just unmute LaQuinta and ask the question.
Hello.
Yes.
Yeah.
Hello.
Hi. No, I was just trying to understand the difference on the 1099 contractors because you hear often of people doing um Uber,
Right.
Shipit, all those different things. So I was wondering if a person was doing 1099, could they use the income statements or those things you said get from the website, could they use that for their business?
They would have to create their own. They cannot use if you're employing 1099 contractors, they cannot use your income statements for their business. They are basically their own business people, and so it would be up to them to do that. So let me give you an example. Uber drivers pay for their own wear and tear on their vehicles. They pay for their own gas. They pay for their own maintenance and all that kind of stuff. So if they're getting paid $10 for a drive, and the drive costs them $8, they can account for them for that separately in their own business. They cannot use your business. Did that answer your question?
Yes.
Okay.
Okay, I think we are done. No
Okay.
questions.
Let me briefly go through just a couple more points. One of the things that you'll find in the workbook is a statistical analysis. It's very helpful. There are two tabs that provide this to you. One is your break-even point. The break-even point will show you what your minimum income has to be in order to break even in your business. Okay, so it will say, it has to be $5,000 a month or $7,500 a month or whatever it happens to be. You need to look at this so that you have a benchmark. I know I need to make at least $5,000 or $7,500 or whatever the number is in order to make a profit. So that's really important that you understand break-even point. Okay, and you can see the definition here. It's the point at which the gross margin, which is your cost of goods sold, you are taking in sales, is sufficient to cover the fixed expenses. So that's really important. And then there are a whole series of financial ratios that are really helpful to you. And I'm just going to move ahead real quickly. This is what the break-even analysis looks like. And you can see here's your gross margin, 151,000, and that's your sales less your cost of goods sold. It's 43% of your total sales. And here's your payroll. It's all broken into there. And then, so your break even sales in dollars is calculated. Here's your total fixed costs. And you divide that by 43.6%. Okay. And that gives you what your total yearly revenue has to be. And if you divide that by 12, in this case, it happens to be $31,551. This business has to generate $31,551 in sales every month in order to break even. So this is a good example. The total sales of 347,000, and they have to generate 378,000. What that is telling you is that this business is not going to break even, because their sales, 347,000, is less than their yearly break-even amount, 378,000. Okay, so they are about 31,000, 32,000 off of what they have to sell. So that's why break-even analysis is so important. Okay, and then I just want to skip over that, and we've gone through session 4. Your score mentor can help you with additional explanations if you need it. The next session is really helpful if you need funding. The next session is on funding sources. Dan Toll, I think, is going to do that, and he is excellent at helping you understand funding sources and how to apply and the various sources that are out there. Are there any last questions before we adjourn for the day?
Nope, we're all set.
Very good. Thank you all for attending, and we hope to see you next week and at other